Let's get more insight into that with Martijn Rats, Morgan Stanley Chief Commodities Strategist. Is that what is to blame for this huge boost and boom that we've seen in the metal prices? Is it all to blame because of natural gas and power prices?
Yeah, to a large extent it is. But it comes against the backdrop of generally strong demand more than we can supply. For a while during the sort of the heart of the lockdowns, a lot of spending that we all used to do on some travel and leisure was converted to spending on goods. Spending on goods is favorable for metals demand. It was our expectation that when the reopening happened, that spending would shift back and we would go from sort of buying stuff to doing things. We had that strap line for a while, but it just now seems to be strong demand across the board. In the energy commodities, we see strong demand for transportation fuels, but still in goods demand, we still see very strong spending. And it's just we're running up against the world's ability to deliver all these things, and that is tightening across the board, and particularly in the sort of broader commodities complex.
Yeah. Martijn, what impact will the reopening of the North Atlantic have on kerosene demand?
Very positive. It's a relatively straightforward read-through. And it is particularly important for really the entire oil complex. So if refiners make gasoline and diesel and jet fuel is a product that sort of sits in the middle. If you don't use the molecules that would otherwise go into jet fuel, you can partly blend them a bit into gasoline and mostly into diesel. So you can use these molecules elsewhere, effectively then increasing supply of these other types of oil products, gasoline and diesel. Therefore, these pools of demand are then a bit oversupplied. What happens when when jet fuel demand comes back? You need to extract these molecules out of the diesel pool, out of the gasoline pool, and therefore also those pools then tighten up. And with that, the entire barrel tightens up. That's really favorable for refining economics, and the refineries start to run faster. And you can see how that would then have a broad tightening of the entire crude market as well. So it's very important.
Love talking about the molecules. You're talking my language here. So is the path of least resistance, say, for oil up? Like, what's the bull case potentially here if we're already sitting at 84 on Brent?
Yeah, no, look, there are broadly two stable equilibria for the oil price. It's either the oil price needs to be so low when we're oversupplied that it destroys new production. That's the marginal cost of production. That's one anchor. The other stable equilibrium position in the oil market is when the oil price is so high that it destroys demand, which is what we need when we're undersupplied, which is now. So really what's just happened over the last 12 months is that we went from effectively the supply destruction price to the demand destruction price. Who knows exactly what the demand destruction price really is? On the supply side, we can do a lot of analysis, but on the demand side, it's much tougher, particularly under conditions like this, when there is a lot of economic stimulus in the system. People, have pent-up savings, keen to travel. Who knows really what the demand destruction price is? At some point, a couple of months ago, we thought maybe $80 a barrel. There doesn't seem to be much sign of demand destruction yet. I think we can go higher.
Okay. Well, that leads me on to how much higher, but I'd also like to ask a question about gas. So briefly, how much higher?
Look, like, $10, $15, who knows? It's all possible.
That's a lot. Okay, but that's not going to be small. Martijn, let's talk about the gas price here in Europe. It's gone parabolic. There's all kinds of factors in the mix. Hard to get a sense of what's really happening. What is your assessment of the picture? Is the market overpricing kind of the demand story and the supply story and how much Russian gas we're going to get? Are we at the point of maximum pain?
Yeah, for gas, we would say so. So our view is clearly constructive on oil, but we are quite cautious on natural gas. Look, in a way, this is not so contradictory as in the gas price has rallied so much more. Gas is so much more expensive, almost by any metric. Inventories are low, that is true, and that has created a degree of concern in the market that has underpinned this price rally. But we would say they are not so low that it would really threaten sort of outages, even in case of a cold winter. We are very close to the level where natural gas inventories in Europe are actually sufficient to even get us through a cold winter. They're actually over the last couple of weeks filling again at better rates. There is already some demand destruction taking place. We saw more news about that even today with several headlines. And then it is also our expectation that in the end, once Russia fills up its storages, more supply from Russia will be forthcoming. We've held that view for a while, but also today there's been some news indicating that that indeed will likely to be the case. So we're more constructive than the forward curve on oil, but we're a bit more cautious than the forward curve on natural gas.
No, fair point. So what's the potential downside if, as you say, we're almost good to go in Europe if there is a cold winter, and if there's not, if it's just not as cold as we think, what's the potential downside here?
Yeah, look, I mean, natural gas in Europe used to trade $6, $7, $8 an MMBTU. Now we're at 30. We will not fall back to $6 to $7 an MMBTU, but something in the mid-teens, like $12, $13, $14 an MMBTU. Actually, in a month or two, when we have a bit more visibility on whether the winter will be cold or not, would be an entirely reasonable price.
Wow. That's quite a big shift from where we are now. Martijn, greatly appreciate the analysis. Thank you very much indeed. Martijn Rats of Morgan Stanley, greatly appreciating your time today.